Welcome to Street Check, the weekly podcast from Cabot Wealth Network, which has been in the investment publishing business for more than 50 years, producing research, insights, and recommendations since 1970. I'm Chris Preston, Chief Analyst of Cabot Stock of the Week and Vice President of Content.
And I'm Brad Simmerman, Web Editor and Chief Analyst of Cabot Wealth Daily. Today, we will talk the latest inflation report, what that means for the Fed going forward. We'll discuss bank earnings. What are we seeing for the consumer there? And I forgot the third leg of our big three. Chris, what is number three?
Number three is, okay, so this is a good way to sort of lead into what's going on and where you live and what's going on where I live. We're going to talk about green tech stocks. When will they actually get going? Because they've been hailed as the next big thing for years, and they still just can't quite get it going. And the reason this is top of mind with us, you live in Arizona, where the temperature is currently
somewhere in the neighborhood of 97. It is 8:46.
Okay, but it's 8. I should point out 8:46 a.m. your time. What is the high today?
114. It'll be maybe as high as 117 this weekend, and then above 111 for at least the next 10 days.
That sounds fun.
No respite in sight. It's a bear. I was emailing Michael Brush of Cabot Cannabis Investor. We were just talking about this because he just got hit by the wildfire smoke in the Northeast. And the thing that's remarkable is that there's been no let up, right? Yep. Like we will occasionally hit these high temps, and it's unfortunate, right? Like you're inside a lot, you're using the AC, you're in the pool. But you typically get like a day or two where things sort of get back to normal and you can cool off a little bit or go outside, and it just hasn't let up at all.
Yeah.
And like I'm dealing with this, and you guys just got hit with the worst flood Vermont has ever faced. Is that
since 1927? Well, I think it's comparable to when Hurricane Irene came here in 2011. I live in Vermont, which has been in the news lately. We're not used to getting extreme weather other than ice cold, but everyone who lived on the rivers really got it bad. I think the Winooski River rose to like 21 feet, which is the highest since the 1927 flood, the great flood of 1927 in Vermont, which killed 85 people, including the lieutenant governor.
Wow.
Fortunately, this one, I don't think there's been any deaths. Thankfully, the state's response has been good, but yeah, I mean, Montpelier, the capital, the downtown there, flooded. Yeah. Waterbury, which is a town I used to work in, flooded. There's a lot of places that are just totally flooded. But fortunately, I don't live near a river. I'm fine. As you can see, I'm not doing this from underwater, under the sea. So, so that got us thinking about, we're at two very different extremes. So it got us thinking about climate change and green tech stocks, which we'll get to. And then I think our segment today that we're going to do is called Jump Ball. We did this a month or so ago. Just you and I go back and forth on two different things under a certain topic, and see which we think will perform better over the course of, before we said rest of the year. We can expand it beyond that, but
that should be a fun head-to-head kind of segment for us to play with, and hopefully will lead to some good high energy conversations. But before we get into any of that, Chris, it is your turn to defend the in this case, maybe not wildest take I've ever heard, but probably an appropriate one. So the S&P 500 will not decline by more than 5% for the rest of the year. 90 seconds.
Yeah, or even 5%. Okay, so going back through the last 3 times that the market emerged from a long, deep bear market like the one we've experienced in 2022 and early this year, there's been 3 times that since the turn of the century, in the 21st century. After the dot-com bubble burst around 2000, September 2002 was the bottom. And it started to get going, but then there was like an 11% pullback, and markets didn't really get going until early 2003, like early March 2003. And then it didn't let up. There were no pullbacks of 5% or more for the next 13 months. 2009-10, emerging from the subprime mortgage crisis. The bottom was March 2009. Market started to get going, but there was a 7% pullback in June and July of that month, or of that year, and another 5% pullback about a month after that. Then it got going, no let up for 10 months. 2020, coming out of the COVID crash, April was the bottom, or March 2020 was the bottom. There was a 5.7% pullback in June, 6.8% pullback in September, October. Then it didn't let up until literally the end of 2021. So my point is, we have had two pullbacks since the bottom was in October. The bottom from the S&P was in October of 2022. There was a 7% pullback in December, a 7.7% pullback in February, March of this year. So I think we've gotten our two big pullbacks, big-ish pullbacks out of the way. And I think this is going to run for at least through the end of the year and probably early into next year before there's even a 5% pullback.
Maybe. The one thing that had me thinking of is there's two ways. If a stock gets overbought, right, there's two ways for it to sort of revert to the mean. It can either correct down or it can correct laterally, and then time sort of allows moving averages to catch up. So yeah, I think that's perfectly feasible. Even if we don't have like a major correction or a major pullback, the market can effectively do the same thing by trading sideways over a period of months. So like maybe we stay strong through the summer, trade laterally sort of towards the end of the year without any major pullback. But
yeah.
I mean, my crystal ball is as broken as ever. So
yeah, and I'm more looking back at history in terms of going off of like what Mike Santolo, our expert, stock market timer and growth investor that we have here, does. He looks at the whole history doesn't
repeat, but it rhymes.
Repeat, but it rhymes. Yeah. So the last three big bull or bear markets we've emerged from, there's been fits and starts with 1 to 2, 5% to as high as 11% pullbacks in the months after the new bull market started. And you and I sort of identified, you thought maybe this bull market started back in December, and within weeks of us saying that, this is one of the few things we both got right, was we had actually entered a real bull market. Well, in new bull markets, and now it's gone from like sort of a technical bull market led by mega caps and just AI to like a real bull market. When new bull markets arrive, they don't tend to slow down. As our Tim Lutz always said, trends last longer than anyone ever thinks they will. And new bull markets, it's the same thing. Just like bear markets, just like what we saw in from December till we actually entered bull market territory about 6 weeks ago. Markets climbing a wall of worry. Everyone's saying, Fed, everything, it can't possibly happen. Well, now with new bull markets, everyone's saying, well, it's a similar wall of worry, but just kind of different verbiage, or people are saying overbought. This can't keep happening. They have to come down. It's too frothy, and then it keeps rising.
Something in an uptrend can stay overbought for the duration of the trend, right? Like that's the marker of the uptrend. The wall of worry. Now people are worried that the market tops out.
Right.
And I think that's probably a good point to transition to our next topic, namely CPI came in better than expected. And what do we think that might mean for the Fed and that sort of overhang of high interest rates? Because we did see interest rates approach their prior cycle highs.
Yeah, so inflation 3% or 3.1, which was expected. That's literally a third of where it was roughly a year ago. Was it 9% last June, I think? or was it? Yeah,
It's that's about right.
yeah,
8.7 or something, but yeah.
yeah. Or I think it got to 9.1. I can't remember
Mm.
which month that was, but
That's
so that's such a precipitous drop, and we're close to the Fed's 2% target. It made me wonder, whether the Fed, who has been basically all but said they're going to raise rates at the end of this month by another 25 basis points, and has said they may raise them as much as two more times this year before finally hitting the pause button or stop button. It's almost like they've come too far in saying they're going to raise rates at the end of this month. They can't back out now.
yeah.
I think they still will, but assuming the inflation rate continues to go down, even if it goes down to just say 2.9% next month, I think that's license enough for them to be like, okay, we're 2% range. We can stop now. What do you think?
I'm a little bit on the fence about whether 3% inflation is going to be enough cover for them to continue the pause.
Well,
Um,
I'm
I,
saying I think they will go ahead and raise at the end of this
I,
month.
yeah,
Um, I don't
I'm
think there's gonna be any
thinking,
more after this.
I'm wondering if maybe we've already gotten enough for them to not hike again. I know the
Oh,
market right now, the market's pricing in expectations of like 95%, maybe 92%. I haven't looked at the Fed Watch tool today, but somewhere in the neighborhood of 90 to 95% is what the market is expecting uh for a rate hike of 25 basis points. So that's consensus in the market.
yeah.
Um, but at the same time, I don't see a huge impetus for the Fed to hike rates if what they're saying is this has been effective, meaningful interest rate policy. We will see the result of it sort of extrapolate out over quarter to quarter to quarter to quarter to quarter. Inflation down to 3%. Banks are stable. Employment is strong. Um, I guess it really just depends on how committed Powell and the FOMC are to that 2% inflation. I think I'm on the same page with you. Yes, rate hike this month.
Yeah.
Because they very intentionally did not move that 2% target. We had speculated in the past, hey, maybe they say, okay, well, if we can get down to 2.5%, that'll be we'll consider it mission accomplished. But they never really even entertained that. I haven't seen any commentary, anybody saying that they should be that they should accept a higher rate than 2%. That's the most compelling case that I can think of that yes, they're going to make that rate hike is that they are totally committed to inflation just not even being a thought anymore. But I don't count me as stunned if the Fed comes out and says, hey, it looks like we're on the sort of soft landing path. We're
Yeah.
not going to raise in July, but we'll reconsider it in September.
And let me just say, everyone at Cabot, Mike Sotelo, especially, but a lot of people give the Fed a lot of crap, but Fed, they've done a pretty good job. I mean, still no recession in sight.
Yeah.
Getting the soft landing. At least, I
It,
mean, this could be famous last words, but 3% inflation with no recession in sight, pretty good.
and yeah, and we saw, and I will sort of softly transition to the second of our big three, the bank earnings coming out today. We saw big banks report better than expected earnings. JP Morgan beat last year's quarter's revenue by 10 billion. They beat quarterly expectations for earnings. They reported 475, beat by 78 cents. Citi came in worse on quarterly numbers, but they exceeded expectations, and I believe they're trading slightly higher today. All the banks cited the net interest spread, so they're what they make on deposits versus lending out, right? So they pay you 0.25% for your money, they lend it out at 7%. They pocket that 6% spread effectively, and in exchange, they take the risk of default. So the cynic in me says, hey, big banks are just not paying you enough on your deposits. You should be making more on your savings account. But given the regional bank headache that is still sort of circling the drain. It's still out there. It's not fully gone. Um, People are willing to accept the safety in exchange for lower deposits. So it's great for bank earnings, but they're still highly leveraged to the strength of the American consumer, which hasn't slowed down. It's been propping us up for the whole rally, essentially.
Exactly. And that leads to, so just a broader earnings discussion. Banks are in the news today because they lead things off. But so can you guess what the fact set, according to fact set, the expected earnings growth or decline for the current quarter that just started, the second quarter earnings? What is the expected performance this quarter, would you say, among analysts, economists?
Decline of 6%.
Close, 7.2%. That
Man,
seems pretty steep to me. That would be the worst since second quarter of 2020, which notably that was when we were all in
post-shutdown,
our
yeah.
houses and spending, all we were spending on was endless Amazon boxes and Pelotons. So and that was 31% decline. I feel like people keep getting this wrong. It keep I don't know if overestimating or underestimating the economy. I think earnings decline, sure. 7.2%. I have a hard time seeing that happening.
I think one of the things that is probably contributing to that is a lot of companies have become so accustomed to lowballing targets,
Right.
so that they can come out and bang the beat and raise drum. Like, oh yeah, we beat. I know our expectations weren't super high, but we beat them, and we're going to raise expectations going forward. So I do think some of that is optics priced in, right? Like the actual earnings hit is probably half that.
Yeah.
I think when it's
still
all
lowest in
said and
3 years, lowest expectations in 3 years.
Yeah, it's the much promised but never arriving recession. It's fears that the consumer is not going to stay resilient. I mean, there's we had talked about it. There's sort of a deadline for most consumers until, right, like excess savings was down to $500 billion or something, like, or no, was down from 500 to like 75 billion. I don't remember. We talked about these figures a couple of weeks ago, but is there, like, what's the breaking point, right? There's going to be a final straw eventually. We'll get a recession at some point. Maybe it's this next year, maybe it's in 10 years. At some point something will break. Maybe the Fed keeps hiking, and then it becomes really, really hard for smaller companies to get financing, or for companies to refinance commercial properties. I mean, that's one that is sort of a ticking time bomb right now. There'll have to be a straw, but I don't think we've seen it yet. So I do think that the second quarter earnings projections are maybe a little bit overly pessimistic.
Yeah. Okay, let's move on to number 3 in our big 3. We mentioned you and I live in 2 very different concerning weather extremes from this week and, well, ongoing for you. There was also the wildfires in Canada and elsewhere. Climate change has been top of mind this summer or the last couple of months. Then why do green tech stocks still suck? I mean, we've been hearing that these are the next big thing for what, a decade, and they haven't. Let me pull up. So the best way to follow the clean energy sector is something called the Invesco Wilder Hill Clean Energy ETF. PBW is the ticker symbol. That peaked at 133 basically in February 2021. It is now at 30. Hold on, let me get it. Sorry, 42. I mean, it was even as high as 95 end of 2021 before stocks pulled back. Everything else has gotten going, or not everything else. A lot of growth sectors have gotten going. This one, not so much. I mean, it's up, let's see, only 10.5% year to date, below, trailing both the S&P and the NASDAQ. Why is there such a disconnect between spending on clean energy and clean energy stocks?
I think I think it's a mistake to call them green tech in the sense of setting investor expectations. Um, let's say, look at a traditional tech company, Facebook, right? They can deploy new software and they can roll it out to 8 billion people instantaneously. Green technology is, yes, technology in that it's growing, it's developing, it's new assets, new technologies, but the deployment of it is very boots on the ground. So it's great if you can take a solar cell that goes from 32% efficiency for power generation and bumps it up to 39%.
Mhm.
But that's sort of where the tech comparison ends. At that point, you then have to deploy it, which is like infrastructure building, right? Like I would love to have solar power everywhere, but we've got 1 trillion miles of high energy infrastructure and power lines that need to be replaced, that need to accommodate it. So it's more of an infrastructure and build out play than it's actually a technology play.
Yep.
One thing that I wanted to look at specifically that I had mentioned with the Inflation Reduction Act, right? That had a lot of green tech spending on it. The biggest aspect of it, or the biggest component of it, and I'll put a link in the description, is the Greenhouse Gas Reduction Fund. It's a $14 billion allocation out of the entire bill.
Yep.
That is being deployed to 2 or 3 national nonprofits who will then go on to partner with private capital financers. The next largest allocation is empowering rural America. They are going to fund rural electric cooperatives, borrowers of the Rural Electric Administration, rural electric companies. So the capital allocation is happening sort of in 2 tranches. One is big funding to nonprofits or big funding to existing government or non-government entities to then use and deploy at their discretion. The other funding tranche is a lot of grant programs. These grant programs have terminal dates anywhere from 2026 to 2031. So, the impact is that we're seeing from climate change is obviously immediate, right? You're seeing flooding. I'm seeing the heat we talked about earlier, but the passage of the bill is sort of a binary event. But the actual rollout of the funding of the building, that's going to be something that takes another decade. So, as innovative as a lot of these products are, they're not overnight success stories. I think, maybe when you see some backlogs start building up, specifically among some of the energy infrastructure players, that'll probably be a marker that it's actually going to pay dividends, literally and figuratively, and it'll be a profitable pursuit. But I think that's probably the first clue to look for is a buildup of backlogs. But remember, these investments are going to take years to play out.
I'll give you more history on this. I'm looking at this Wilder Hill Clean Energy ETF PBW chart. It launched at 78 a share in February 2005.
Yep.
And actually, I misspoke. The top was at 140 in late 2007. So if you bought on the clean energy premise when this came public, bought the CTF almost 20 years, 18 and a half years ago, you'd be down not 50%, but by more than a third.
Yeah.
There's been fits and starts. If you could have made money if you bought and sold at certain times. There's been big run-ups, especially after 2020, but it's just hard to trust.
There's an element to it that is that it's sort of hand-holding with super risky assets. So the same people that were investing in tech up until the tech bubble in like 2001, the high risk investors, they had to put money somewhere, and it went into to green tech in 2005 to 2007.
Yep.
They abandoned it when it didn't deliver immediate profits. Came back 10 years later, and I guess the Yeah, we'll move on. I think that the investors and like the mindset of a tech investor that's a high risk investor doesn't actually align with the deliverability of green tech, which is really more of a boots on the ground manufacturing infrastructure type play.
Yeah. Okay. All right. Let's move on to our aforementioned jump ball segment, backed by popular demand, and by popular I mean you and me. So okay, the premise of this is we don't know going in which side we're going to take, but basically two things: we pit against one another, we see where we fall on what we think will perform better. We could say through the end of the year, but just what would you buy now?
Yep.
This first one we'll say through the end of the year. Large cap stocks, small cap stocks. What do you think?
I would have probably had a different answer 2 weeks ago. I'm going to go large cap.
Really?
Yeah, I think Mike convinced me. He had written about one of the large cap tech stocks in Growth Investor, just talking about, and I'm not going to go into too many details, but just talking about the markets, how the markets value leadership. We've said on this podcast, and Tom has written, this market rally either needs to broaden out or it peters out. The case for small caps is a broader rally. But if the rally broadens out, then the rally leaders are going to outperform as well. So I'm going to go large caps. I would have said something totally different a week ago.
So S&P 500 large cap stocks up. What's it highs? As we speak, up more than 17% for the year. Small caps gotten going lately, but up only 9%. Even though I agree or don't disagree with your premise there, I think just because of the disparity between the two, and because the rally is broadening out and is pulling up small cap stocks, I have a hard time seeing the S&P being up, say, 30% this year. Whereas small caps, I could see getting to 20-25%, narrowing the gap between the two. So I'm going to go small caps. I think by the year's end, you could see the Russell 2000 up a little over 20%, S&P like 25%. But the question is from here, and I think from here, second half of the year, I think small caps will outperform.
Yeah, I do think small caps are maybe going to be a little bit more dependent upon Fed activity. If we get a rate hike in the upcoming meeting, and then the Fed says, "Hey, the odds are pretty good that we're going to hike again in August," that makes borrowing more expensive. It makes speculating on smaller investments effectively more expensive. You need to generate more of a return for a small company to justify having somebody invest in it versus going out and buying a T-bill paying 6% or whatever. So I do think that small caps are going to face a tough environment if we've got rate hikes on the table.
Okay, let's go to the next one. Next jump ball. Biotech. This doesn't have to be limited to just this year. What's the better investment right now? Biotech or semiconductors?
I'm going to go semiconductors. And that gets back to some of that order backlog stuff we were talking about, right? Like the semiconductor demand is not going to slow down. Biotech demand won't really slow down either. We need to discover new drugs. We need to discover new medical devices and all of that. But it's going to be a lot tougher to get funding for biotechs. The same sort of stuff we were just talking about with small caps, I think will hit biotechs harder than it hits semiconductor manufacturers. And especially with NVIDIA's windfall, they just came out and they funded $50 million into a green tech company or into a alternative energy company, and then the stock rallied like 80% that day. NVIDIA right now, with the combination of semiconductor demand and AI, has the Midas touch. I'll take semiconductors over biotechs.
So XBI, which tracks the ETF that tracks the price of biotech stocks, up only 1.3% year to date. The VanEck semiconductor ETF, SMH, up 56% year to date. I'm going to go against what I just said in large caps for small caps. I think I agree with you on semiconductors because just they're tethered. They're a part of the artificial intelligence rally that we're seeing, and I think there's no slowing that right now. And I think there's there's no real momentum for biotechs, where there's all kinds of momentum for semiconductors. Obviously, that can change in the blink of an eye, but
Yeah.
I think given the how robust the growth in artificial intelligence is, and sort of by proxy semiconductors, I think semiconductors are the answer.
Yeah, if you're automating the entire world, you need a semiconductor in everything. And that's seemingly what we're doing now.
Yep. Okay. Next up, banks. We just talked about it. Earnings were good for the big banks
Yep.
earlier this morning. Smart value play or stay away?
I'm stay away on banks still. If you're gonna buy a bank, I would say somebody like a Citigroup that's trading at sort of draconian valuations. Like it's been absolutely hammered, but it's too big to fail. But somebody like, Bank of America, JP Morgan, Wells Fargo, I don't see a ton of upside there. I mean, yeah, maybe we just get more consolidation in banks and their deposits grow by 10% because every regional bank fails in the US, or like whatever doomsday scenario. I don't see where they're really going to juice the margins. Institutional trading volumes were down across the board. So uh, maybe as we get towards the second half of the year, if we start seeing more institutional participation in the rally, and more big boys, coming into the market again and getting out of cash, they could maybe juice the returns. But for me, the risk of, if we're lumping all banks together, the risk of buying an individual bank stock and then that bank falling out of favor is worse to me than sort of the aggregate return of all banks as a basket.
Agreed. No notes. No, I mean, yeah, I wouldn't buy banks right now. We have some very smart value investors, Bruce Kaiser, Rich Howe, who have been recommending a few banks lately. But I just think it's been a tough environment for value stocks, period. And banks, they're still shaking off sort of they're still trying to scrub off the stain of, just a few months ago having this big collapse, even though it didn't involve the big banks. I don't think there's better places to put your money right now. I think there will be a time when things shift from growth to value, but I don't. What we just talked about is a new bull market. I don't see that being worth taking a flyer on banks right now.
My one caveat, and I'm glad you brought Rich up. Those he is dealing with banks that are in like special situations
True.
that
Yeah.
where there's this arbitrage possibility where it's like, okay, well, if I buy and hold this, it could 2x or 1.5x or whatever over the next couple of years because of very specific situations. If you've got a candidate like that, yeah, go for it, buy it, that's fine. But if we're just talking about buying a basket of banks, I'm skipping. I do like some of Rich's bank picks, and if you'd like to see them, you can subscribe to Cabot Microcap Insider, and you'll get the best banks that Rich has identified, which I actually kind of like. I don't own them, but I like them.
Yeah. Okay, next up, better international investment. Better place to invest internationally: Mexico, Southeast Asia.
Give me Mexico. I just saw a headline, and I was telling you this. Mexico is now the US's biggest trade partner.
Right.
The value of nearshoring, and like I mean, I heard there have been political pitches to start bombing Mexico, which is insane to me. And you shouldn't be a political candidate if that's your proposal. I think you should just walk away. But Mexico is our most important trade partner. We've got a ton of shared DNA just especially living here in the Southwest, right? Like I speak Spanish. I'm a little bit rusty, but I took it for a decade. We visit Mexico fairly regularly. It's always been great.
Say in Spanish, I think Mexico is a better investment.
Pienso que México es el mejor investamente. I don't know how to say investment. That's one I don't
close
know.
enough. You had me convinced. Yeah, I agree. Mexico. Not only is Mexico, so our Carl Delfeld, who runs our Cabot Explorer investment advisory, sort of a global investment advisory, has written about and actually bought a stock based on the premise that Mexico is like a 25% discount to manufacturing discount to what you get in the US and China. As a result, not only does the US want to do business with Mexico, but China increasingly is too,
Yep.
and other parts of the world. So probably touch on Southeast Asia. Growth is strong there. I think you mentioned Vietnam as being one particularly
Yep.
appealing place, but it doesn't. I guess it doesn't have. I mean, I have the one just it doesn't have quite the hook that Mexico. We have a 25% discount, and we're the U.S.'s biggest trading partner. It doesn't quite
Right.
have the same hook right now, at least, I guess.
Yeah, and I mean, right now we're in sort of a more globalist political alignment, right, with the Democrat in the White House. If we go back under Republican control and they need to renegotiate trade agreements, it's going to be way easier to do it with Mexico. Um, the value of proximity and transit is when we have uncertainty is valuable to me. Like, we don't have to rely on ocean shipping. We don't have to rely on flights. We can throw stuff in the back of a truck and get it across the entire country of Mexico and vice versa.
Yeah,
So there's a versatility there. There's a reliability, and they'll be easier to work with than probably trying to negotiate with ASEAN, the ASEAN, Southeast
yeah,
Asian Economic Group. Um,
yep,
Anytime you're negotiating with a bloc, it's always harder
yep.
than just negotiating with individual countries, or even just negotiating with Canada and Mexico simultaneously. So I think over the long haul, Mexico is probably a better investment opportunity, but
Yeah.
I'm frequently wrong. So
If Congress changes drastically between now and next November,
yeah,
uh, then and the White House changed drastically, then yeah, I'm sure there'll be an anti-Mexico sentiment that suddenly surfaces there, and then that this could easily
yeah.
flip. That's a year and a half from now. Okay, so this next one's simple. What's the better buy? Maybe better mega cap tech stock buy for the rest of the year? Nvidia or Microsoft?
Microsoft. As much as I love semiconductors, Nvidia has turned into like a mono trade. It's
Mhm.
all it's all AI and semiconductor demand going through the roof, right?
Up
It's pretty
221% year to
yeah,
date.
yeah. It's nuts. I feel like, I mean, and I know I was just saying, hey, market leaders are going to keep leading, and I think in the short term and even intermediate term, that's true. But I do think that the sort of black swan event risk of Nvidia would be if there's a sudden decline in demand, right? Like, if everybody that says they're going to start using AI data center stuff, if they all come back in this quarter's earnings and say, hey, we piloted it and it wasn't really meaningful and it wasn't a huge benefit, so we're going to cancel some orders. Microsoft, on the other hand, the products are so ubiquitous. There's going to be demand for Microsoft Office suite of tools, sort of regardless of how this AI thing plays out. So that would have me. I mean, maybe it's more of a slow and steady kind of pick, but give me Microsoft over Nvidia.
Yeah, I agree. I mentioned Nvidia 221% year to date. I think it's the single best performing, at least large cap stock on the market. Microsoft 45% good, but they're part of artificial intelligence is a big part of that. They're one of the AI leaders too. I just think there's going to be. I'm not saying Nvidia will be down between now and the end of the year, but I think Microsoft has more room for growth there. And yeah, like even if it's slow and steady, I still sort of trust it more than Nvidia at these levels.
Yeah, I just, that valuation is so high, and like, all right, well, there's always sort of like the greater fool that comes along and is willing to buy an overpriced asset from you, and like, there's a lot of those. We saw it with crypto and GameStop and all that, GameStop and all that. But
Yep.
that I would be more afraid of being the sucker that comes to the table late with Nvidia. Maybe I'm wrong. Maybe it runs 50% for the rest of the year and Microsoft is up 15. I don't know. I personally would just be more comfortable allocating a portion of my portfolio to Microsoft over Nvidia at these levels, just
Yep.
like you said.
Okay. We'll do quickly. Let's do two non-investment related ones. Shohei Ohtani, the maybe the best baseball player ever. It's one of the best pitchers in baseball and certainly the best hitter in baseball, at least this year. Where will he be in six months from now, or maybe even 6 weeks from now with the MLB trade deadline coming up at the end of the month? And how much money will he be making?
I have no idea.
He's a free agent, by the way, end of this year.
Yes.
So that's why we're talking about.
I've always been sort of the casual baseball fan.
Yeah.
I sort of tune in after the All-Star break. The D-backs have only been a team since I was in college, so it's not like I have this childhood. I mean, I do. We used to go to Cubs games and A's games because spring training is big out here, but I was never a huge baseball guy. It's more casual fan. I've heard New York, right? New York, LA, just because they're sort of destination locations. But here is the dark horse candidate that I will pitch. It is my Arizona Diamondbacks, and the reason that I'm bringing that up,
the Bill Simmons podcast, I think the Celtics. Oh,
the reason I'm bringing that up is the Suns recently had a really, really good offseason free agency. I mean, they probably did more to build their bench than any other team in the league. Part of that was adding Yuta Watanabe, who is a fan and associate of Ohtani. He's been photographed wearing Ohtani jerseys, and he said on the record, we should try and play for the same city sometime. It would be, it'd be good to live there and have another high-profile Japanese national. So I'm going to pitch the D-backs. As for dollar amount, I don't know, $426 million over 9 years. Is that?
I'm going to go Dodgers.
Okay.
Not till this offseason, $600 million. Because basically, I think the highest paid now is something like $450. It was his teammate, Mike Trout.
Yeah.
Notably, they've had the two best players in baseball for the last 5 years that have never even made the playoffs, which is why we're having this discussion. He will go to the Dodgers for $600 million because you're buying two players. You're buying one of the best pitchers in the game and probably the best hitter in the game. He might even get, like a 1% share in the Dodgers or something like that. It'll be
like a Kansas City deal for Mahomes.
Yeah, he will be the highest paid athlete this time in about 6 months. By middle of the hot stove winter. Okay.
In all likelihood, he's not actually going to the D-backs. They will not cut those checks. They haven't spent big money on anybody since they created the team in the early 2000s.
Yeah, right? Randy Johnson
or late 90s. Yeah, exactly. So they don't cut big checks. He won't go to the D-backs. But I did want to throw that out as a possibility.
Okay, last question. Super Mario Brothers just made and counting $1.3 billion at the box office. There's another 80s, 90s toy nostalgia movie coming out, I think this weekend, Barbie. Will that make over $500 million at the box office?
I'm saying yes. Yes, it will. Directed by Greta Gerwig, did Lady Bird, which was phenomenal. I'm familiar enough with all right, Ryan Gosling, Margot Robbie, they're Ken and Barbie. They shot rollerblades. Why do I know all this? There's no reason for me to know all this, but I know all of it, and I'm kind of interested. I think we'll probably all go see that movie. I think it passes 500 mil in the box office globally, not domestically, but globally.
I'm going to bring in our producer, Madison Robertson. You're a film buff, I think. Barbie, 500 million or more, or less.
That's so hard because to me the trailer looked weird.
It does look very weird.
I won't be going, but it's exactly what Brad's saying. I could tell you so many scenes from it because they did such an incredible job marketing it, and I think that people will go for the sole purpose of saying that they went, and because they probably bought all the merch from every single store that's also it's now Barbie themed.
Yeah. I think I'm going to go below also, just because this one is expressly for adults. As you mentioned, the director has made films for grown-ups. Lady Bird, I think she did Little Women maybe too. Anyway, whereas Super Mario was just for all ages. So I think it'll do well, but I think I'm going to go below 500 million.
So
it's a big number.
My counterpoint there is Little Mermaid. It was broadly criticized. It was sort of lambasted in China. It made 544 million worldwide. There's
but
definitely
also for children, right?
I don't know. My kids didn't see it. Did yours?
No,
I
but
think it's
they're
for
interested.
young.
They saw the trailer. The trailer was in a children's movie that we went to. I think we saw Elemental, and it was there, or maybe it was something else. I can't remember. But
Yeah. But I think it's targeting that sort of that same early, like young adult. I was a kid in the 90s, kind of
right.
the generation below us. Maybe, I don't know, Madison could have spoken to that. She's more in that age range than I am.
Are they advertising Barbie? Sorry, real fast, Brad. Are they advertising Barbie is not for children?
I don't think so. I haven't
Let me
seen
let me see the rating.
Because that was the first that you saying that's the first time that I've heard that.
There is definitely the possibility that Barbie
PG-13. PG-13.
Oh,
okay. There's a possibility that it's like what happened with Babylon or Amsterdam, where you get like all these high profile stars and all these cameos, and then nobody cares and it loses money, right? Maybe it's a huge flop, but
Babylon and Amsterdam are just abstract, vaguely familiar words, whereas Barbie, everyone knows.
Yeah, it's so zeitgeisty. I think it beats 500 million, but
okay,
thankfully I'm not a studio head right now.
Right.
And I mean, that's
none of whom are working.
Well, that's the other thing is, okay, well, let's say we look past Barbie and what other big major blockbusters are coming out or high profile movies. Like, there's not a ton, and a lot of stuff that's in development has been delayed now because of the combination writer and actor strike. So there may be people wanting to get out and just go to the movies and see another big high profile pick for as long as they are able to.
Right. Yeah. Go to the theater now, because there might be a gap there for a while, similar to 2020. Okay, we got to go. Before we sign off, again, as always, subscribe if you haven't already done so. Give us a 5-star rating. Hit the like button. All of it. What else should they hit, Brad?
Smash that subscribe button, peeps.
Yep. Okay. Thanks for joining us. We'll be back next Friday with another edition of Street Check. We'll have some guests who will probably be very mean to Brad. And we will see you next week.
Bye.